Welcome, Theo Traders. This is Brandon Chapman for the Theonite video for Monday, May 2nd, 2022. And what a way to end April. If you notice where the futures began back here on the 31st, we closed. It was one of the worst performing Aprils that we've had in a really, really long time. And it makes you wonder what's on the docket for the future here. I mean, it has been a roller coaster market that ended higher on today's session. And we've got an FOMC statement coming up on Wednesday where they're likely to raise 50 basis points. And oh, by the way, as recently as the end of last week, there were expectations for 75 basis points increase in the next meeting in June. So there's a lot of uncertainty right now that's roiling markets. And again, I just wondered, at what point do we start to have the fatigue on the bearish side or the bullish side? Now, we can kind of measure the fatigue on the bearish and bullish side by looking at what we call capitulation. On Friday, and even intraday today, when you look at the VIX did move significantly higher towards the prior highs at around 36 or above 36. Friday, if we were to bring up like a 2 ATR Keltner channel, 20-day Keltner channel, you'll notice that we did close outside of it on Friday as well as April 26th. When you get these kinds of points, it is a level that oftentimes you see a little bit of buying come in. So if we go back to the SPY, we use that as a proxy for the S&P. You'll see the 26 was right here. We were able to stage a 2-day rally out of it and before breaking back down again. And so this is, again, where we're at. Again, intraday today, we found a very bearish position with the VIX near highs. But yet, when we look at the VVIX, the volatility of the volatility, we only touched 130. We didn't hit prior levels that were much more extreme, closer to 150. So it makes it look like what we're seeing right now is much more akin to what we saw on April 26th that maybe led to a 2-day rally here versus some of the bigger rallies we saw following a major capitulation event, more significant capitulation event on February 24th. So remember is that, we might catch a couple of day rally out of this, but we've got a Fed statement coming up on Wednesday. We know how the market right now is responding to the fact the Fed is raising rates. There is the mantra out there, don't fight the Fed. I get it, don't fight the Fed. The Fed is raising rates right now. That doesn't mean go out and buy everything that's not nailed down. But you'll notice we're testing a very similar area that we had on February 24th. If you recall on February 24th, if you were looking at declining issues, DECN plus advancing issues, ADVN, we had a rather significant event. So I'm going to bring up the pairs ratio study here. The yellow line represents a ratio of declining issues, advancing issues, and you can't see this intraday. Okay, I can maybe try to bring it up here. So let's go. We'll go 30 minutes. We'll try to go back, 90 days. See if we can pick up on it. You'll see it right there on the 24th. And it was actually much higher than that intra period, right? So this is 30 minutes. But you'll notice we're up here in the 10 to 11 area where we saw 10 to 11 times more declining issues than advancing issues. If we saw volume, DVol plus UVol, this is down volume. The ratio of U volume, $UVol. No, we're not seeing there. Scroll it over. This is only reflecting, 6 times, but intra-period, it was around 10 a.m. Eastern time. It was much, much bigger than that. In fact, let me just try to, 90 days, 27 minutes. We'll shrink it down here. Let's go 10. You'll potentially be able to see the spike in here. You'll see it right there on the 24th. It was early in the morning, just after the open. You'll see 9 to 10 times. So what happened was intraday on the 24th, we did see a 90% day, or intraday anyway. We just didn't finish there, which tells you what? It just tells you that, we had a very bearish event that was much more indicative of capitulation on the 24th. Now, right now, what you're seeing is that we are testing or retesting that same area, and we were able to hold it. Okay, so again, technically speaking, right, that was Friday's low. Intraday, we slipped below it. We open up at virtually the same point. It's probably reasonable we could catch a little short-term bid towards the midpoint of that big candle, or possibly even retesting prior highs at 428. But remember, I mean, these events are generally sold right now. Why? Because we're in a bear market. The Fed right now is looking to aggressively tighten policy. And one thing that's not helping stocks right now is the fact that Treasury yields are surging. Today, at least at one point, you'll see the high right there. The high right there of 30.02. The 10-year reached 3%. Now, if you've been following what's gone on with the Japanese yen, so I'm going to bring up the US dollar / Japanese yen here. It's kind of a big deal. I've been talking about it for a few weeks. We spent a bit of time last Wednesday talking about it here for a big reason. Because the Japanese yen owns about 1.3 trillion in US treasuries and is one of the biggest holders of US dollars. If the yen keeps selling off, and all accounts, they had their meeting last week, they're going to remain dovish, meaning they're going to continue to print money. What are they going to do to defend the yen? They just sold in the last 3 months about $60 billion in U.S. treasuries. So again, you go back 1, 2, 3 months. So again, since the end of January, they have sold nearly $60 billion in U.S. treasuries. Going back to the end of January right here, $60 billion. They're a major contributor to the weakness we're seeing in our U.S. Treasury yields right now. Who knows how much is 10-year or the other mixture of bonds in there. But this is a major, major problem, is we cannot afford to have yields go up with the indebtedness of our publicly traded companies, our private companies, our individuals, and more importantly, our government. Japan has a debt to GDP of about 230%. We're 2.6 for 230, 260%, 250, whatever the number is. We're about half that. Again, we're speedily going to approach where Japan is. And right now, when you see the dollar yen, despite the weakness in the market, the failure of the carry trade to reverse, and to see the yen strengthen, which if this goes down, that is yen strength. Okay, so again, realize that the currency crisis that we're seeing with regards to the Japanese yen, the global supply issues that we're seeing right now, the trade restrictions on Russia, all this stuff is compromising our ability to borrow from the world at cheap rates. And this is going to be an issue. So the idea is you have inflation in terms of prices because of the supply issues, and then you get bid on the other end of it, meaning what? In terms of rising borrowing costs as well. Let me just share this with you here. If you want access to our content here at Theo Invest, all you have to do is go to theotrade.com/magnify with its MAGNIFI, and you can get access to this. But I'm coming here, and if you notice, the employment index figure is 50.9%, 5.4% lower than the March reading. Employment is weakening, and yet what? The pricing index is at 84.6. Yes, it's down 2.4, but a measure below 50 is contractionary. The highest number you can get is 100. The pricing index is not coming down. So we're seeing rising costs of inputs for production. This is for manufacturing PMI. They're trying to pass it on to wholesale. They're also going to pass it on to consumers in terms of CPI as well. But again, what you're seeing is the employment index figure is starting to weaken just above contraction here. So again, this is kind of a big deal. You know, we are in a pickle. Don't expect the roller coaster market that we're currently experiencing to go away anytime soon. One of the things that we teach here at TheoTrade, and it's by Don Kaufman, is again, his background, his experience. We teach how to sell premium. Avoid the roller coaster. There's times where you can trade it. There's also times where you want to trade the volatility and assume higher probability and be hedged. We teach something called inflection point spreads, which has played out very, very nicely here. We teach about how to sell premium and do it in a responsible, protected, hedged way. Okay? So again, don't expect this to turn around. As we look at the QQQ today, the NASDAQ 100 ETF, it was up 1.67%. What's leading this out? Just look right here, technology and communications. Well, communications up 2.76%. What are the bigger companies in this space? In this sector, Google, for example, was up nearly 2%. It came off a pretty not so good earnings last week. So the fact that we're kind of gap lower this morning and rallied off of it, not super exciting. Yeah, I guess we could test the high here. Maybe even get back to resistance around 2,500, but that doesn't necessarily change the trend. What about Facebook? Facebook was up 5% today. It's coming off very oversold levels. Could we get back to 240? Possibly. The high of the gap day back here at 248? Sure. But that doesn't lead to longer term strength in the market. What are other communications, more traditional ones like Verizon? Down today. What about AT&T? Up 1.38%. Their earnings came out, gapped a little bit before the earnings, popped on the earnings, then kind of faded back to support here. Maybe we've got to run in this to maybe 21. Okay, so as you look at the damage that's been done, I mean, it's not super encouraging. XLK, for example, what are some of the top stocks in this space? Microsoft, they did have a good earnings, relatively speaking, and yet the stock really didn't do a whole lot. Can we get back to 292? Yes, possibly. Today, it was a weekly option. This was a 6 May expiration at the 280. Look at this morning. It's kind of filled in and pushed out here. But there was some bullish activity today in Microsoft. Relatively short-term in nature. We got above 280. We began to squeeze higher a little bit as the interest began to roll out. But the point is, this is very transitory interest. Maybe we got to about 290 here. You notice as we kind of extend out here towards the higher strike prices, where did the interest start to wane out here? About 300. Could we get to 300? Sure, if we start to take out some of the bigger areas that have higher short interest, we might see a squeeze to 300. But again, how much does that make back of what we lost just in April? It's only what? About 61%. This is a typical retracement area. It also happens to be an area that is resistance, been a significant area of resistance going back for a long time. So the problem with the market is that what? We just don't have a lot. So if I back this out here, there's just not a lot here between kind of this, 4,100 area until we get down towards 3,400. How do you know that? We're going to go here to the volume profile. This adds up the volume that occurred at each specific price and it totals it here. You notice we are below this pivotal point right here, right? We have a secondary level right here at about 4,100, 4,150. The next major level is where? About 3,300 and really at around 3,000. So what you're noticing here is there's a bit of a vacuum that once we start to take this out, there's not a lot to support it until we get down towards that 3,400 level. These are your major kind of points of control. The next major one down here at 3,000. And the problem is we could get there really quickly. Okay. And so again, you saw this last days. We almost fell into the abyss here today. We're seeing a major pullback on Friday and then today. And again, it presented a little bit of an opportunity. You might take it on a limited basis, but otherwise you might be looking for these bigger sell-off days as an opportunity to sell some premium. Okay. So again, going back to bonds, again, the fact we broke 3% today, this will continue to place pressure. And with the Fed poised to raise rates, it creates some bigger issues down the pike here. A few stocks, as far as unusual option activity today, TLT. TLT was a bit of a mixed one. On the weeklies, there's some definitive kind of put option activity here. A 117, 113, put spread put on there. And then you start to go out a little bit further out to the May expiration. You saw some buyers come in here mostly at the 121 strike. So you got this juxtaposition of near-term weakness and near-term strength. So the idea being is that TNX, the TLT, TLT. The issues we may see some, this might be reflecting some of the pressure we saw today, but we could start to see if the market begins to pull back, if some of the foreign selling starts to subside, we could start to see a bit of a rally in treasuries. But before you start to get any sort of major move, we may need to see the Fed start to go on hold. If they go on hold, look at the second best performing sector today. It was XLE. XLE is basically near 52-week highs right now. We saw a rally. It was Monday back here on the 25th. We were looking at the opportunity to get long, right? We had a pullback on Friday, a nice little kind of piercing line formation off the bearish candle, kind of engulfing candle we had on Friday. This thing could rally back readily towards 80, possibly 81. So near-term energy looks positive. And what's backdropping this is the fact that oil was higher today. And better yet, if you look at forward/CL, what you're seeing is that the backwardation, meaning the falling prices that you're seeing in oil futures, is also bullish. And in fact, when you look at it compared to some of these, the yellow line here was April 13th. This is April 6th. The fact of the matter is the term structure of oil futures is more bullish today on May 2nd than it was in mid-April back here. So what this tells you is the risk right now is to the upside in oil. We'll see if we can, we'll see if that actually materializes in terms of real strength. But again, the term structure still favors that area. Whereas when you look at communications or technology or cyclicals, these are some of the higher beta stocks out there. Yes, SPHB may see a little bit of a rally off a low level here at about 71. It has a high cyclical and technology weighting, but it's coming off a weak level. So when you look at XLE, it's on the opposite side. Another area that's showing strength today is GDX. Now, gold itself is not showing strength today. Gold was down, which if treasuries are experiencing weakness, this does create more weakness for gold. As again, the comparative, yield. Gold is a negative yielding asset, right? So again, this puts these yields in more negative territory. But if treasuries can shore up a little bit, and if the Fed begins to signal they're not going to be as aggressive, which I don't see happening quite yet, again, the move in gold might be delayed, and that's what you saw today. So today you're seeing another kind of further building in this trade out here for December, and it is way out of the money. I guess I got to go to GDX. Sorry, GDX. Way out of the money out here. A 60 and 70. This is a long vertical was put on last week. It's being added to today to the tune of 66,000 contracts. It was traded in one print, buying the 60, selling the 70. So what does this mean? Saying, look, folks, we may very readily see the Fed within the next couple of months. If the market starts to see substantial weakness, stronger dollar might help precipitate that. But if they may start to turn tail and run away from their policy. Don't expect it necessarily, but it's very possible that they might temper it. And if they do, the dollar is going to start to weaken significantly. And we may see gold see a major rally. So you have traders out here putting these big trades on just in case. And this is something that we have seen since January 3rd, by the way. These major upside bets in GDX and GLD and SLV, etc. Again, another major one put on today. And boy, you start to look at, again, these strike prices, 60 and 70, you gain a perspective how far out of the money this is. But remember, we are in unique times right now. And again, if they turn tail and run from dealing with the inflation issues, stagflation may abound. And not only that, dollar weakness is going to be a major source for inflation. On the bearish front here, Home Depot today. Home Depot has been grinding it out. They do have earnings coming up on the 17th. If you've been watching IYR, real estate, REITs rather, having a really bearish day the last couple of days. You look at ITB, very similar to Home Depot, consolidating right now. Get REITs kind of catching down at the moment. But if home prices, again, if the perception is home prices are going to start to drop, people will spend less on their homes traditionally. So we look at HD today. It was a June expiration, so it's out there a little bit. The setup's not terrible given the fact we've been consolidating. It's not a huge trade here, but buying the 295, selling the 270, a downside put vertical for June, basically saying what? They're expecting HD to break, and maybe that break could occur on the earnings coming up on May 17th. And so again, didn't go with the May 20. It was the June expiration for HD. But again, looking for a significant downside here to the 270 strike price and buying the 295, selling the 270, which is down here. So again, gives you some downside potential. On the toy front, Mattel was higher today. Resistance earnings were relatively positive, kind of forming a pennant type formation. If we break out here, we could see another move similar to this, possibly moving to about $28 on Mattel. This one was a June expiration, so it's out there a little bit. 14,000 contracts, mostly bought at the 27 strike for June 17. Basically anticipating a breakout here. So earnings are past. You can wait for the price to begin to move, probably trading through the highs here at around 25, looking at possibly 27, likely 28 at the near term. You'll notice that this right here was a breakout from a kind of a fall. I guess I should probably draw it a little bit differently. It's going to draw as a channel, but it's really more of kind of a falling kind of a wedge formation here that broke out. We have another kind of bull flag form here and another pennant forming right here. Again, looking at upside to about 28. Again, with resistance at around 25 and 50 or so on Mattel. But again, coming off bullish news. Teva. So Teva Pharmaceuticals, this is one where I was bullish on back here. We have a kind of a top and front watch list. We set some targets. Actually nailed the target we had originally. Rip back here. We've got earnings coming up here tomorrow before the market opens. I'll just throw this out. But right before the close today, it was a 6 May, 8 puts being bought on Teva. So you have to watch to see what happens in the morning there. But also, let's circle back to IYR before we kind of wrap things up here. But IYR kind of backing down near support. When you get these big moves like this, sometimes it's hard to go short. But the best way to probably do that is with an out-of-the-money put vertical, casting a line in the water just in case things get crazy. In this case, it was a 13 May in here, buying the 98, selling the 93, downside put vertical with an expectation of $93. So again, the rise in rates, the potential risk spreads widening out. Because if you look at HYG was selling off again today as well. So HYG has been showing weakness. Risk spreads are widening in spite of the inflation that we're seeing right now. There's just no shelter at the moment. And what you'd expect is higher borrowing costs. And again, if we're entering recession, this should hit IYR. But again, it should also hit home builders. And we talked about Home Depot as well. We'll wrap things up with Cisco. So Cisco was interesting. This is one that, is kind of setting up down here. They do have earnings coming up on May 18th. I'm just going to clear my drawing set out here. What's in store for the earnings? It's kind of been a mixed bag. There has been some rotation to tech companies that do pay dividends. But even at that, this company broke support last week. Maybe we're firming up here. If we get a broader tech rally for a few days, you'd probably expect Cisco to do relatively okay in that scenario. But today on Cisco is a rather short-dated option here, 45,000 contracts. We'll see how much that adds to the open interest tomorrow or by rollover tonight. And if we do, this does create an environment where you had some long activity, mostly long activity, at the 5250 strike. And it's only for this week, so it's not even getting you to the earnings. But 5250 is kind of near the prior high. So watch Cisco. If we start to trade through today's high, we may see a little bit of rally. We may see more momentum start to pick up. If this 6,000 starts to translate to open interest, we break 50. You start to add some GAM, even more GAM at 51 and 52, and then maybe exploding at 52.50. And all of a sudden you find yourself near 54 by the end of the week. Again, less likely that's going to happen, but watch it. Again, people are trading based on that possibility with Cisco. Anyway, folks, a lot going on today. Oh, actually, I said I was going to end. Let's look at Redbox really fast. I just want to throw this out. Redbox is up a lot. Volume today was about 159 million. Folks, recognize just the tremendous risk in these companies. This company has 1.2 million shares shorted with a float. Okay? According to Yahoo, the float's 2.7 million shares. Shares outstanding at 12.6 million. Implied shares outstanding 45 million. This is a low float stock with a lot of short interest, maybe 50%, nearly 50% of the float shorted. Again, what you're seeing today with 159 million shares traded, you're seeing that float get turned over 75 times. It's a huge deal. And oftentimes these kind of signal, when you start to turn over the float so quickly, it's just crazy. So be careful of these companies. I mean, there might be limited opportunity here to continue to squeeze. But again, as a shorts cover, and so right now the volume is so high, it can quickly absorb that short interest, and you're not going to know that in real time. So it's an interesting stock to watch, and maybe if you caught it yesterday, but again, be careful of these companies. But this is one that's kind of interesting. You're seeing that kind of short squeeze a la we saw last year, a la what you saw, for example, in a GameStop or an AMC. But for these companies, the short interest waned a bit. We already had the short squeeze in March. Now we'll see where these go again. Anyway, we'll wrap it up there. We'll see you back next week. Thank you.